Intercompany transfer of land and equipment. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our Facebook page, St. Louis Test Prep, the website, and the book, Cost Accounting for Dummies, that I teach in a free weekly live chat just about every week. So we're talking about transfers between a parent and a subsidiary, and this comes up when we are consolidating financial statements. What our goal is to try to eliminate any intercompany transactions, the accounting impact of any intercompany transactions, so that we can combine the parent and the subsidiary and not have the financials messed up, distorted by any intercompany activity. So in this example, this is an intercompany transfer of land, and this happens to be a land sale for a gain. So we have a buyer and a seller. The land is sold for $10,000 and the seller's cost is $7,000. So on the buyer's books, basic stuff, land and asset account is going to be debited and increased for $10,000. That is the buyer's cost, $10,000. The buyer pays cash, we credit cash, or maybe a payable. Seller, on the other hand, has a receivable on their books for $10,000. They took land off their books at their cost, $7,000. To make debits equal credits, they need a credit of $3,000 to make debits equal credits. That is a gain on sale of land. So this is a basic transaction, ignoring for the moment any intercompany activity. Now let's take it to an intercompany transaction. How do things change? Well, when there's a gain on sale, and this is important, it doesn't matter which direction it goes in, whether it's an upstream sale from subsidiary to parent or a downstream sale from parent to subsidiary, what you eliminate in consolidation is the same, and that is that the buyer added an asset account land to their books, and that land account is overstated by $3,000. It's $3,000 too high because it includes the gain. The seller, on the other hand, their net income for the year is too high by $3,000. Now, this is tricky. When we go past the year of the transaction, on the seller's books, instead of net income being overstated, retained earnings in future years is overstated because the $3,000 is still in the financials of the seller. So we make a journal entry to reverse, to credit land to reduce it by $3,000, and to debit net income to reduce net income by $3,000 in the current year. If it was a future year, that debit would be a debit to retained earnings to reduce it. What about a sale for a loss? In this case, the seller sells it for $5,000. The seller's cost was $7,000. The buyer puts an asset land on the books for $5,000. They pay cash or have a payable credit. Seller, on the other hand, gets cash in the door or a receivable for $5,000. They take land off their books at the seller's cost of $7,000 to make debits equal credits. We need a $2,000 debit, and that debit is to loss on sale. In this case, in consolidation, the land is understated by $2,000. If it was an intercompany transaction, the buyer should put the land on their books at $7,000. They only put it on at $5,000. And this loss on sale should also be eliminated. In other words, net income is understated. So in an intercompany transaction, we would need to debit to increase the land by $5,000, and we would need to credit to remove that loss on sale because net income is understated. We need a credit to increase it back to where it should be if we're looking at a consolidated set of financials. If it was a future year, retained earnings should be credited or increased because that loss on sale is an intercompany transaction. So now we make it a little bit more complex, and we say intercompany upstream land, sale of land for a loss. Upstream meaning from subsidiary to parent. So 2002, parent purchased land from a subsidiary. The subsidiary is 70% owned by the parent for $125,000. The subsidiary's cost to the seller is $80,000. On the buyer's books, and I put here in red that this includes both the parent and the non-controlling interest. Somebody else, a single person or a group of people, owns the other 30% of the sub. The buyer puts land on their books at their cost, $125,000. Cash is credited for $125,000. So, on the balance sheet before consolidation, if I made some subtotals, I need to break out 70% of the transaction to the parent and 30% of the transaction to the non-controlling interest. So I simply divide, and I take 70% of 125,000, and I take 30% of 125,000, and so I divide up the debit to the land, and I divide up the credit to cash between the parent and the non-controlling interest. And what I say over here is that both the parent's land account and the non-controlling interest land account is overstated by the difference between the price they paid, $125,000, and the cost of the subsidiary of $80,000. Before consolidation on the subsidiary's books, the seller, they get cash in the door, the subsidiary, of $125,000. They take an asset called land off the books for $80,000. And to make debits equal credits, they need a credit gain on sale of $45,000. So the subsidiary's net income is overstated by $45,000. In consolidation, there is no gain, and there is no higher asset value for the land on the buyer's books. So we need to reverse that. So what would our entry be in the year of the transaction? We're going to debit to reduce the gain on sale. We're going to credit to reduce the value of the land, which was overstated. In future years, because that transaction stays on the seller's books and on the buyer's books, in future years, we would debit retained earnings to eliminate the gain on sale. We would credit land to reduce the overstated value of the land on the buyer's books. If you can imagine a T account, you can see that the land is on the books at the higher value. We credit in an elimination entry. You can see the gain on sale was created during the intercompany transaction. We debit to remove it, so we end up with no gain on sale, no credit. On the land, the asset account, we end up with a debit of $80,000. One more. What if the land was sold for a loss? What if the land is sold for a loss? I'm going to jump over to an equipment transaction. Now, some of this we already saw. Here's a basic transaction. But what I'm going to show is an equipment sale for a loss. So, equipment sold for $3,000. The seller's cost is $7,000. Because it's equipment that depreciates, we have accumulated depreciation that needs to be removed from the books. So the buyer debits an asset account equipment for their cost, $3,000. They have a payable or they pay cash. The seller gets cash in the door of $3,000. They take equipment off their books at the historical cost of $7,000. We're given in the problem we have to debit to remove accumulated depreciation. There's nothing to depreciate if we don't own the asset. To make debits equal credits, you're seeing that the gain or loss is the thing we figure last by posting the difference that we need to make debits equal credits. In this case, we need a $2,000 debit to make everything balance.